percent of the premiums held by the captive. Second, the special provisions of insurance law allowing captives to take a current deduction for an estimate of future losses, and in some circumstances shelter the income earned on the investment of the reserves, reduces the cash flow needed to fund future claims from about 25% to nearly 50%. In other words, a well-designed captive that meets the requirements of 2005 to 40 can bring about a cost savings of 25% or more. While some businesses can meet the requirements of 2005 to 40 within their own pool of related entities, most privately held companies cannot. Therefore, it is common for captives to purchase third-party risk from other insurance companies, often spending 4% to 8% per year on the amount of coverage necessary to meet the IRS requirements. One of the essential elements of the purchased risk is that there is a reasonable likelihood of loss. Because of this exposure, some promoters have attempted to circumvent the intention of Revenue Ruling 2005 to 40 by directing their clients into bogus risk pools. In this somewhat common scenario, an attorney or other promoter will have 10 or more of their clients' captives enter into a collective risk-sharing agreement. Included in the agreement is a written or unwritten agreement not to make claims on the pool. The clients like this arrangement because they get all of the tax benefits of owning a captive insurance company without the risk associated with insurance. Unfortunately for these businesses, the IRS views these types of arrangements as something other than insurance. Risk-sharing agreements such as these are considered without merit and should be avoided at all costs. They amount to nothing more than a glorified pre-tax savings account. If it can be shown that a risk pool is bogus, the protective tax status of the captive can be denied and the severe tax ramifications described above will be enforced. It is well known that the IRS looks at arrangements between owners of captives with great suspicion. The gold standard in the industry is to purchase third-party risk from an insurance company. Anything less opens the door to potentially catastrophic consequences. Abusively high deductibles. Some promoters sell captives and then have their captives participate in a large risk pool with a high deductible. Most losses fall within the deductible and are paid by the captive, not the risk pool. These promoters may advise their clients that since the deductible is so high, there is no real likelihood of third-party claims. The problem with this type of arrangement is that the deductible is so high that the captive fails to meet the standards set forth by the IRS. The captive looks more like a sophisticated pre-tax savings account, not an insurance company. A separate concern is that the clients may be advised that they can deduct all their premiums paid into the risk pool. In the case where the risk pool has few or no claims, the premiums allocated to the risk pool are simply too high. If claims don't occur, then premiums should be reduced. In this scenario, if challenged, the IRS will disallow the deduction made by the captive for unnecessary premiums ceded to the risk pool. The IRS may also treat the captive as something other than an insurance company because it did not meet the standards set forth in 2005 to 40 and previous related rulings. Private placement variable life reinsurance schemes. Over the years, promoters have attempted to create captive solutions designed to provide abusive tax-free benefits or exit strategies from captives. One of the more popular schemes is where a business establishes or works with a captive insurance company and then remits to a reinsurance company that portion of the premium commensurate with the portion of the risk reinsured. Typically, the reinsurance company is wholly owned by a foreign life insurance company. The legal owner of the reinsurance cell is a foreign property and casualty insurance company that is not subject to U.S. income taxation. Practically, ownership of the reinsurance company can be traced to the cash value of a life insurance policy a foreign life insurance company issued to the principal owner of the business or a related party, and which insures the principal owner or a related party. 1. The IRS may apply the sham transaction doctrine. 2. The IRS may challenge the use of a reinsurance agreement as an improper attempt to divert income from a taxable entity to a tax-exempt entity, and will reallocate income. 3. A life insurance policy issued to the company may not qualify as life insurance for U.S. federal income tax purposes because it violates the investor control restrictions. Investor control, the IRS has reiterated in its published revenue rulings, its private letter rulings, and its other administrative pronouncements, that the owner of a life insurance policy will be considered the income tax owner of the assets legally owned by the life insurance policy if the policy owner possesses incidents of ownership in those assets. Generally, in order for the life insurance company to be considered the owner of the assets in a separate account, control over individual investment decisions must not be in the hands of the policy owner. The IRS prohibits the policy owner, or a party related to the policy holder, from having any right, either directly or indirectly, to require the insurance company or the separate account to acquire any particular asset with the funds in the separate account. In effect, the policy owner cannot tell the life insurance company what particular assets to invest in. And the IRS has an